Are you eating lunch right now?
It's a yogurt kind of podcast.
Yeah, this is going.
Oh my God. Oh, that's where we're starting.
So I'll apologize now. Business is kind of slow.
No, thank you.
Business is slow. We need to share this. All right, what are we doing?
Appreciate you guys. I have Bryan Laflamme and Miguel Jose here with me. And Alvina and I started this podcast just over 2 years ago now. And we've brought in people that are kind of hyper local in our community that we felt that were ultra successful. And it's not always about the monetary side and accolades and stuff like that. It's about overcoming certain things. But I wanted to bring you two on because when we're meeting with our clients and we're talking with our referral partners, our agents, financial advisors, you know, we talk about the knowledge base and that success because you two do exactly what Alvina and I do on the lending side, and you guys do it very well, and you both do it differently. Everyone in our core group do things completely different, but it all works out. And so when we talk about, we often talk about like a mastermind where we have a knowledge base and we communicate. So when clients are working with us or referral partners are working with us, it's not just what's in here and what we know. It's like we talk to a core group that has decades of experience and tons of at-bats and successes under our belts to where we're able to help at way more rapidly and at a higher level. And so I wanted to bring you two on. It's going to be probably a little bit difficult to not crack jokes and make fun of each other because that's our culture here, which I absolutely love. But I want you guys to kind of share some things. And there's two main things we want to kind of talk about that's really kind of pressing right now. One is what's kind of going on in the real estate world, specifically for our real estate, referral partners and let our clients and the public kind of see what that's like and how we engage and why it's so important to have a team that's cohesive and on the same page, pulling in the same direction so we can be successful and get that win and get the family in the home, but also kind of, distill down what's happening, the media, the news, you're hearing about rates coming down and, Bryan, you're very technical and you have a really good way of explaining it to where it's easy to understand. And I feel like, Miguel, you do it in a way where it's like you're verbally painting pictures. And so I think it's been kind of cool to kind of hear your take on it. And talk about what's coming up with potential lower interest rates and what that's going to, what's going to happen with people that have bought over the last couple of years, as well as, if you're looking to, maybe buy, your first home or second home or investment properties kind of moving forward. So, but yeah, I want to thank you. I appreciate you guys coming in and taking some time to talk about it and try not to make fun of each other too much as we talk about.
Miguel and I think I speak for him as well. You said you've been doing this for 2 years, bringing super successful, hyper local people in. I'm glad it took you 2 years to get to us.
Everyone's on vacation right now, and
he needs
I lost a bet. Okay,
within this block of Puyallup is what you've been bringing in, and it's our turn.
If people know you and I, how we interact, I'm really just trying to get fired today. Is what's happening, so.
I think this is a tough time to be in our industry, in real estate and lending, or to be looking to buy a home right now. But tough times make tough people, and a lot of people have unfortunately not been able to make it through. Those who have been able to make it through have done it, like you said, in their own way, but in a way that has proven to be effective, because it is incredibly difficult. And I don't want to lose that, the empathy of what we do, what real estate agents do, but also home buyers and the decision that they're making, whether to pull the trigger or not to pull the trigger in a time where they're hearing a lot of negative information. We have 2008 in our rearview mirror that we just keep looking back on as consumers and saying, well, we want to superimpose what's happening now on what happened then, and the fear that is out there. It's palpable every day for us when we're talking to people. It is one of the biggest parts of our jobs now is overcoming that fear with actual data and information. And then once somebody has that data and information, if it's the right choice for them, that's awesome. If it's not, that's cool too. There's no right answer that we can give everybody. Everybody has their own right answer.
Yeah, it is. And it's really easy to talk yourself out of opportunity when the entire world around you is constantly filled with negative information. And we seem to be kind of in this climate where everything's really, kind of polarized you're totally in a place now where everybody's concerned about the economy. It's even weird that we're arguing whether or not we're in a recession, right? And you go to the grocery store and common sense tells you that things are more expensive than they've ever been. And the affordability metric is very difficult. But with that being said, we're still getting people into houses every single day. And we're talking our clients through this process. And if you can eliminate all of the noise, most of the people that are buying, not investors included, but owner occupied borrowers, they're not purchasing for the monetary metric, right? Like they might think they are until they go out and look for homes. And then all of the things that matter to us aren't really connected to the money part, right? You start visioning your family there in the school districts that your kids are going to go to and the life that you want to build. And you start going, whoa, that's the actual real value. And now what we have to do on our side is, can we fit that picture that you painted in your head into this financial bracket that works for you? And that's where all three of us are really good at that, is going, can we make this work for you?
Yeah. There's a saying that, sometime I'm gonna mess it up. Something like price is irrelevant. Price is only relevant in the absence of value. And when people come and talk to us, it's very much about price. What is my payment going to be? How much money am I going to have to bring to the table? What is this going to cost me? And when they go out and look at a house, it's really, what can I get? I joke with my clients a lot that I think I must have slept through a meeting somewhere because I get to tell them all the money that's being taken from them, and I don't get any of it. But like, I feel like I was asleep in a meeting, and then someone's like, "Hey, who's going to tell them how much escrow costs and title costs?" And then
you're the guy.
It landed on the realtor, and I'm like, I have to take all of your money, and your realtor gets to give you a house. Yeah. This is an incredibly inequitable relationship, but that's the experience too. They come and they figure out what they can afford, and a lot of times it's very exciting. And there's almost nothing like the feeling of telling somebody you do get to buy a house. Like our society is incredibly failing incredibly in teaching people financial literacy.
Yeah.
It's funny that it took me so long to get that sentence out that ended in literacy.
He's trying to read the cue card there. Yeah.
And we don't tell people. So when someone comes in so afraid of whether or not they're going to be able to buy a house, and you tell them, yes, this is a reality for you. You get to do this, and you can afford to do this. Like, it seems like something for someone else, some esoteric thing that is not for you, that other people do, and it's too much of an adult thing for most people. But when we tell them they can, that feeling is incredible. And people, like you said, are doing it every day. In our homebuyer classes, I go over a statistic that I found while I was teaching a class for my business partners about in the Seattle area, the percentage of people who spend 30% or more of their income on housing. And then it breaks it down by renters and homeowners and then age groups. And one of the most sobering statistics is something like 64% of renters age 65 or more spend 30% of their income on housing, which to me means three things. One, they don't have any housing security, because if rent goes up, they're going to have to move. They can't retire, and they can't live out their golden years because they don't have the wealth to do that, because they spend so much of their money on their housing. And then three, they don't, painting with a broad brush, I think most of us want to leave something to our loved ones after, and they just don't have that, and it's so sad. And when I talk to people every day, and they talk about rates are a little bit higher than they would like, or maybe the mortgage payment is a little bit higher than they would like, housing is expensive for you right now. You know who it's not expensive for? People who bought in 2018, 2019, 2020.
Exactly.
They felt it was, but it's not. And it is a 30-year fixed mortgage is the best hedge against inflation you can have. Your housing payment stays the same. Those stats that I just went over about the people who spend 30% or more of their income on housing, the homeowners are much, much less. 18 to 24-year-olds spend a lot, of course, as homeowners and renters. And then it goes down a lot as you get into middle age. And then it comes up a bit when you get into your elder years, because most people have assets by that time. They don't have as much income if they've been homeowners. But still, even that number is something like 30-something%. And so when they bought their house when they were younger, it took up more of their income than it did as they progressed in their careers, as maybe they got married and had dual incomes or whatever life happened, and their housing payment stayed the same.
I feel like that's a fantastic place to kind of really kick this off, is this idea that most of the population doesn't have financial literacy, and it's completely not their fault because it's not taught.
Right.
And it's ultra confusing.
It is. Yeah.
And you have to go and seek unique answers.
Mm-hmm.
Like even the idea of inflation that we're talking about, the idea that there's inflation at all is bizarre. Like a house doesn't take more man hours to create, it doesn't take more material. Nothing's really changed, but the prices are moving.
Mm-hmm.
And those prices tend to move because the denominator that we value it off of is changing in value, even though the numbers remain the same. So you have $1 in the bank account, mm-hmm. and that appears to still be there, but when you go to use it, all of a sudden that dollar doesn't buy what it used to buy. Right. And that plays into what you're saying, where when you go and purchase a house, you get to fix today's dollars for tomorrow. Mm-hmm. And we know tomorrow's dollars are going to be worth less than today's dollars. And so if you ever want to do a fun exercise,
it's not going to be fun.
Go ask mom and dad what they paid for the house, then go ask grandma what they paid for the house. And when you do this exercise, I bet you when they tell you that they originally bought the house, it was expensive and mm-hmm. it was hard and they had to figure it out. But then as time went on, it got easier and easier and easier. And you really don't get this light bulb moment until you're 5 years into owning and you go, oh my God, that's the best decision I've ever made.
Yep.
Yeah.
Even there's a stat that's going around for mortgage and real estate about how houses have appreciated over the past 83 years. And they've only gone down 7 times in the past 83 years, even with high rates, and prices have compounded over and over and over again. Mm-hmm. To your point about you have the same amount of money, it buys less stuff. The asset, for whatever reason, goes up in value. And so as the asset goes up in value, it's worth more dollars to someone else, but you then get those dollars. It is that, I mean, of course, that is probably pretty obvious, but the thing about inflation is your money gets less valuable or your asset gets more valuable. So if you have money in other assets, like you're big into cryptocurrency, mm-hmm. Or if you have it in the stock market, or if you purchase real estate, anything that is an asset, that as the dollar is devalued, that goes up.
So when you're talking about the inflation side of it, when we're coaching our clients, some of the initial conversations, before we get into, I guess, taking a step back, before we get into like the refis and mm-hmm. everything else, it's, everyone's talking about rates coming down. We got to understand where we're kind of coming from and why we got there on the inflation side of it. And to your point, Miguel, it's we talk about the 3 most important things when someone's looking to buy a home. And we can look back historically on when people, let's use, your brother when he bought in 2020 or 21, and then your aunt that bought in 2015, and your parents in mm-hmm. 1990 or whatever that is, right? There's actually 3 things we're going to look at. There's the acquisition time, mm-hmm. acquisition cost, and then the cost of money. What's that mortgage? What's that interest rate? So all 3 are really important, but the most important ones is the timing and the cost. You can't go back in time and change when you bought it. Mm-hmm. You can't change that cost, but you can always, in theory, go back if rates come down, you can always readjust the cost of that money over time. So let's go back in a situation where it's 2021 and rates were coming down super low. Cost of money was low. It's great. It was like a badge of honor that I got a 2.5% interest rate.
Yeah, it was a badge, wasn't it? People just flexed on that.
Exactly. And they probably got that interest rate, but they probably paid $100,000 more than what they probably should have or could have on if they would have bought it in 2019.
Yeah, there's a trade-off.
Exactly. So we talk about that a lot, and it's like, well, what would you rather do? Would you rather buy it at this lower price point, or would you, and maybe be able to adjust the cost of that money at a later date, or would you be willing to actually take a lower interest rate but a higher price point because it's so competitive? At the end of the day, time is going to solve that either way. It's time in market, just like if you talk about, stocks or
like Warren Buffett. Not timing the market, it's time in the market.
Exactly.
Yeah. And let me chime in on that really quick, because the why behind all of this stuff really matters. If you think about purchasing a house, it's like a hedge against government incompetence. Okay. So, and I'm not talking red
as
or
if
blue
the government
or,
could be.
Just trust us.
It's knowing with certainty that politicians are going to promise something in exchange for getting elected, and that something always costs money. And that money generally comes out of thin air, right? And so if you track the money supply or you track the debt, for as long as I've been alive, there's been this concern about this debt, and this debt keeps getting exponentially larger, and everything that anybody wants seems to get more expensive. So if you want a house, it's more expensive. If you're a watch guy, that's more expensive. Fine art's more expensive. The S&P's more. Is there anything not?
He's a
more
man
expensive?
of the people, you guys. Watches and fine arts.
The audience is
I don't
tuned
even
out,
have a
but-
watch on, by the way. But
He can't tell time. He's illiterate.
But here's my ultimate point, guys. My ultimate point is this: because you know that the money is going to continue to get debased, there's never going to be a time in history where it's bad timing to get in the market if you're a long-term thinker, right? So if you're going, all right, if it was the 1900s and you bought something in Manhattan, well, were you too late? And then you go to 1950, were you too late? 2000s, and you go, there was never a bad time.
Right.
And you can actually do this in our local area. Go to Lake Taps, go back, 30 years, and you can check every time. There's never been a bad time to do it if you're a long-term thinker. So this whole idea, like when people call and they go like, did I miss it? You're like,
Right.
Miss what?
No.
It's infinity.
Yeah, it is. And that's not just the modern monetary theory of we can continue to print money because the government will always back that money and we can always raise taxes. We have our military. That's not even talking about that. The fact that people can agree or disagree about what we should do with the debt or how much money we should print. But the reality is it will continue to go up and it's not going to go up 19-20% a year. Thank God.
Yeah, that's
Nobody
a problem.
wants
If
that.
it's
That's
actually
the
a problem if it does,
That's
which
a
it
huge
has.
problem. But 4% compound appreciation on a 3.5 or 5% down payment, or even a 20% down payment, you're in the long term. That is your retirement. That is your kid's college. That is not a bad time. Most countries, we're one of the few countries that have a 30-year fixed, 15-year fixed mortgage program. Even Canada has recently moved to it, but before it was much like our commercial lending program, where every 3 to 5 years you had to turn that over to whatever interest rates were at the time. And investors and banks love that. Do you think that investors want to keep those 2.5%, 3% mortgage rates that they have on the books now? No way. Not in a 6-7%, but they have to.
Yeah.
On the inverse of that, though, if rates go down from the 6 to 7% that they are at now to 4 to 5%, you as the homeowner get to move down where the bank doesn't get to move you up, you get to move down. So the value continues to increase, and then the money can get cheaper and cheaper, but it won't get more expensive with your outflow. I feel like we're harping on this.
You get to cheat a little bit.
Yeah.
You kind of get to take a shortcut, because if you ignore a house and you just looked at anything else and you go, hey, at 16 years old, if they told you could fix the price of gas on a 30-year fix, would you do it?
Right. 100%.
Right.
Yeah.
And a house is one of those weird, unique things where they let you, I can't even figure out why they let you do it, because it doesn't seem advantageous for the other side. It seems very advantageous for you as the homeowner.
Yeah. And most people don't keep a mortgage for 30 years. The duration is about 7 years. And that's why. And the interest is front loaded, so they make a bunch of front. But okay, that's fine. There's a game both ways, but you still get to benefit from this. None of us, we all are homeowners. The one regret I have as a homeowner is that I ever sold any real estate. You guys, another fun game to have if you've ever purchased a home, and if you're around our age, is go back to your first house.
Don't do it. You'll be so mad.
The first house I bought was a condo. So I have 2 stories with this. A condo in Hawaii when I was 22, when I was in the military. And I sold it when I got out of the military. And God, I hate that. I hate looking back and seeing it. But also, I was out in Seattle on a date with my wife 1.5, 2 years ago. And the server had a Hawaiian accent. And so we started talking about how I used to live in Hawaii, and she did too, and I asked her where she lived. And she said, oh, she lived in Kapolei, which is where I lived. And I was like, oh, that's kind of cool. You lived there? She goes, yeah, I lived in the Aliloa Terrace, which is where my condo was. And I was like, oh my gosh, I lived there too. When did you live there? And she said like 2001 or 2002 when I lived there. And I was like, that's crazy. That's when I was, she's like, yeah, but I was just a baby. And I was like, oh man, that was
crusty.
Oh, so that is the two regrets
Yeah.
that you'll have, is ever selling or ever meeting somebody who lived there when they were a baby.
Yeah.
You were a full-blown homeowning adult.
I saw some thing. One of the people in corporate sends us a daily email, and it's just like a quote, and it said, all of self-help really comes down to convincing you to have delayed gratification.
Mm-hmm.
And this idea of financial education really does come down to that. Can you be a long-term thinker instead of a short-term thinker? And almost everything bad that happens in our life comes down to this idea of short-term thinking. I mean, down to diet, like, should I eat this cookie? Like, nah,
No, bring yogurt on the podcast. Don't be weird.
Yeah. And so same thing.
Make it awkward, but don't be weird.
Yeah. So the same thing for me. My first house was in Federal Way, and I think I was 20 years old, and I bought the thing for $149,000, but I was a short-term thinker. I'm going to flip this thing. Oh my God, that was dumb.
Yeah. It's every time that we boomered our parents when we were young. We are that now. Like, I'm telling my kids, like, hey, as soon as you get out of college, you're buying a duplex, you're renting out the other side. You don't have a choice. Like, I'll help you do it. You don't have a choice. So you're doing this and you're never selling it. And I think that's a big deal. Like, that we put our own money where our values are. That we believe in this so ardently that, yes, I'm going to do this as well. And I'm going to mandate that my kids do it, because they're not going to be short-term thinkers of, hey, I'm getting out of the Army and I want some money to start a business, so I'm going to sell my house. Or, hey, I'm going to flip this instead of hold it for the long term, when you totally could have held it for the long term. And bought a bunch of Bitcoin. Yeah, tons.
I was talking to an application this morning with a client, and
braggy.
Yeah, one of yours is pretty good. But I literally had this conversation about our first house that we bought, paid $189,000 for it, and it's about 3 miles away from our current house, and so I know the neighborhood well, and they're averaging probably 680 now, and
back to Miguel's point, it's the same house.
It's the same house.
Nothing changed about the house.
Exactly.
Yeah.
So it's like, I don't, we were talking about because he rents. He's from Australia a couple of years ago.
Sorry, guys.
It's time to eat your yogurt.
Go again. And that's our yogurt break. Word from our sponsor.
You guys did want to cover, we'll talk about the 5,000 foot level picture all day, but people do want to know, like, what is happening in the market. And I think we started a lot of this off talking about the bigger picture, because it is important to have a grasp on that. And then when we get into these details, if you are trying to take advantage now, Bryan's probably one of the best at it, really understanding the nuance of the markets. And no one has no one can tell the future, but if you're trying to do a good guess, Bryan's the nerd that reads the data.
Yeah. It's everybody's a nerd for something, and I'm just happy that that's the thing I'm a nerd for.
So are we.
Right.
What's happening? What's going on?
What I'm getting from a lot of people right now, a lot of clients, is, hey, I think I want to wait till September till the Fed cuts interest rates. And what people don't understand about that is what that rally has already happened. The market traders don't wait until the day and then make the trade. They try to forward run the market. They want to see where it's going, and that's where they place their trades. That 25 to 50 basis point rate cut, so 25% to 50% of 1% rate cut. An average Fed rate cut is 25% of 1%. That's already priced into the market. That's going to happen. Now, the only way that the market is going to react is if the Fed cuts more or doesn't cut at all. Like, if they surprise some way, then the market will react positively or negatively. And a lot of times we can just know what the market's going to do and then the probability that this will happen is, more probable than it not happening. And so that's where we're going to put our chips into. So if you're waiting, this is not going to be seen. It's not going to be seen in a sentence.
Yeah.
This is going to be seen after the Fed meets in September of 2024. But the lesson here is, if you see a thing coming on the horizon, just know that much smarter people than all of us have already put money on one thing or another. And whatever you think is going to happen has already happened beforehand. So if you're watching this before that, or before the next two meetings that are going to happen in 2024, there is a 100% rate chance right now the market is pricing in of 4 rate cuts by January. Now, that notoriously moves back and forth with market sentiment. but the rate cuts that are coming are already being priced into the market. So if you think that the Fed's going to cut rates in September and then mortgage rates are going to go down to the fours, that's just not going to happen. What we have now is a nice leisurely move downward in interest rates. We're down over 1% in mortgage interest rate from just 6 months ago. So that's a huge move downward from 7.52 to 6.52.
So I was going to say real quick here. So Bryan's so dang smart, and all he does is nerd out on this stuff that sometimes the language on it can go over the average consumer's head. If you guys think about this the most simple way, all of these data points is just simply information for people to place bets. Okay. And they're bets on all these different markets. They're bets on stocks and bets on bonds and bets on crypto and bets on whatever. And a lot of people are under the impression that there's like a guy in the back room that just says rates are going to do this. Cause you guys get the call like, hey, what are you, when are rates expected to come down? Right. Like, well, I don't know, I'll just call the dude and ask him, but it's actually free market. So this idea that when the Fed cuts rates, we think that mortgage rates drop. The Fed cutting rates is a data point to speculate on what you think is going to happen with mortgage bonds. So Bryan, who reads a lot on this, could tell you, well, I think mortgage bonds are going to do this because of this. But at the end of the day, it's all us placing our bets on what we think is going to happen.
Yeah. If a lender tells you they know exactly what's going to happen, they're lying to you. You just can't.
Need to walk out.
Yeah, the German bond market and the Japanese yen market we saw last week, all are things that just two of the things that affect our mortgage interest rates. And we have these really complex financial instruments that are traded to, hedge funds and institutional investors and professional stock traders and bond traders that we chunk down into bite-sized mortgage rates and payments. And so it's difficult. I like to tell clients a lot that I couldn't do what you do day one, but I absolutely expect you to do what I do the first day. You're coming alongside of me and making lifelong decisions on very new information. And it's super complicated. Get somebody or learn from somebody that you feel like knows what they're talking about and cares about you. Because the market's going to go where the market's going to go, and you just got to make sure that the person that you're depending on really cares about it.
Nothing's more wild than going to lunch, telling somebody a payment, coming back from lunch and going, oh my God, I have to tell them for some reason that it costs more.
Yeah.
Like that, when I first started this, I don't know, however, I've been doing this way too long, but that was probably the most wild thing. Like I couldn't comprehend that it changed.
Yeah.
Like nothing works like that. Right? Like imagine you go and look at the car and they're like, you want to test drive it? And you get done with the end of the test drive and they're like, yeah, dude, it's 5,000 more. You're like,
that's happened to me where I went to buy a car and then when I was going to sign for it, they had a second sticker on top of it that was like $3,000 more. And I was like, what are you doing? Like you can't just raise the price like that. And of course I took it down, but that makes me feel that way when the market moves. And then now it
makes you feel like a bad person.
Like I did it.
I did it. Right. Like, and we all do that. We all have that kind of weird guilt. We have zero control over the market, but the last thing we ever want to do is call one of our clients and tell them, hey, this went up, because we feel like they look at us like it was our fault.
It's our responsibility to guide them, and we're fallible and not in control.
Yeah.
Yeah. The education process of this is, I think, absolutely critical. And I feel like we do a good job. I know you guys do a great job, and you just have to instill that confidence to where it's like, the line is basically drawn in the sand, right? You're under contract. We have this amount of time to pick our rate.
Yeah.
Here's where we're at right now. Here's what the risk reward is going to be. And I think we're all pretty good at like, hey, we probably need to lock this in because this is the news that's coming up. This is our trajectory, and this isn't going to be good if we kind of don't lock before this, or hey, we have momentum. Let's ride this out a little bit more. And so that's where we all kind of bounce these ideas off each other, or these questions like, are we locking? I mean, because I'm seeing this, and what's our risk? Like, if it's there, at the end of the day, we want to make it the client's choice, but it's almost like blindfold them. Okay, which one do you want, right hand or left hand? Like, I don't even know what I'm picking.
Yeah.
This is the risk. Here's the reward. If it was me, this is what I would do and why, and try to get it to where it's their decision. They feel like they're part of it, versus like, you gave me that rate. I don't want to have that ownership. I want to be part of like
Yeah.
helping them make that decision based on educating them as much as they want to be
And
educated.
the decision people have to make when they're thinking about the rate is, am I going to be more upset if I lock my rate and rates go down, or if I don't lock my rate and rates go up?
Exactly.
We think it's going to go this way or that way, but we don't control it, like Miguel said. So you have to decide for yourself: am I a person who lets it ride, or am I really conservative with this? And I think that I'm comfortable here. And I would always err on the side of conservatism with this. Like, I want to be comfortable with this payment. So
think about this. Was that you who sent it in the group text this morning about like the inflation?
Talk about the group text.
Yeah, we do not have a group text. The inflation or the recession thing, where it was like, dude, chime in on that, because it's so funny. Like yesterday, all the financial markets were like, yep, we're in a recession. Oh no, we're not. Right?
Yes. So it was somebody had an incredible tweet about the beginning and ending of recessions for the past like 15 years. Mm-hmm. And so they went from like all the recessions that we've been through. And then this last one was August 4th, 2024 to August 5th, 2024, because the market went down that Friday. And then we had that yen carry trade thing the next Monday. And so the markets really, really sold off big time. And people were like, oh my gosh, the world is burning. And then today we had some retail sales numbers that showed that people are outspending a lot of money still. Like, they're not acting like they're in a recession. After last month's numbers showed that, oh my gosh, nobody's spending any money.
Right?
Yeah.
It's the knee-jerk reaction thing that I talked about with what the market expects the Fed to do with their federal funds rate. It vacillates so quickly because people are making trades on that information right away about where they think it's going to go.
And you have a large group of professionals that say that the data is not black and white. So like, they're like, oh, employment numbers are up. And they're like, well, actually, here's what's happening. Guys are going out and driving Uber and they got 3 jobs, or someone got laid off and got rehired.
Right.
And so even when you have the data, you have literally multiple parties arguing if the data is accurate.
Mm-hmm. And the trading happens in real time with data faster than we ever could. Mm-hmm. There's algorithms that trade. If the number comes into this, you do this. If the number comes into this, you do this. And so then we have to react to that as well. So what do you want to talk about for rates or for the market?
Well, so just to kind of put that part of it to bed, like, so moving forward, because everyone's talking about refinances, and at least in our industry, but even with our clients, they're seeing, we're getting the calls, we're actually reaching out and trying to be proactive, like, hey, might be a good time to kind of do a review. That's part of what we do. But I think you answered it, but just to kind of, I guess clarify it, like, whatever's going to happen has already been baked into where our pricing's at right now. If there's going to be a difference either up or down, is where it's going to either move up or down as far as rates. But moving forward, they're going to continue to take that data, and inflation's a big part of it, but inflation's kind of lost its momentum because of how inflation works on an annualized basis. So really what we need to kind of look at and watch is, it has to do with the employment aspect of it, because the Fed has dual mandate, keep inflation down. We're kind of level at 3% roughly, give or take. It's going to be probably a long time, hard to kind of hit that 2% for a bit. But the other side of that is they got to keep people employed. And if unemployment rates are starting to come up, that might be a reason why, hey, we got to, because if you look at it from the way the Fed's looking at it, it's like, hey, we have to make money less expensive, so we keep businesses wanting to grow and expand to hire more people because people are more employed.
They've painted themselves into a corner.
So it's a juggling act. I mean, I don't know if I don't want that job.
I think the real simple answer that all 3 of us would agree with is that we're probably headed in the direction of down more likely than up.
It's just not a straight line.
And it's just not a straight line. Yeah. And what the 3 of us are going to do is, when the opportunity makes sense for our clients, we're not going to try to overthink it. If it makes sense, you're going to capitalize on the opportunity. And guess what? If it makes sense again a year from now, we're going to capitalize again.
Yeah. We had at the beginning of the year, we had rates drop down into the 5.99% for a bit after.
It was in February. Phone blew up.
God, you guys got a good memory.
After the Fed came out and said they thought they'd have 3 rate cuts this year, and the Treasury Secretary said they were going to bring supply down a bit, we had a huge rally. That rally didn't last forever.
It's like 3 days.
Yeah, the people that didn't lock in on that are regretting it. Yeah. So waiting to jump into the pool until you're absolutely sure that the water is a perfect temperature, you're going to miss out.
Yeah.
It's just impossible.
It's impossible to time it. And so if it makes sense now, it makes sense now. And we're refinancing a lot of clients now that locked in at 8.25% at the end of last year, because that's where rates were. And we said, hey, don't buy this rate down. Rates are going to be coming down. You can have the rate that you're wanting to buy down now for free later. Yeah. Like, it's not going to cost you anything now. So take 6 months of a $230 a month higher payment instead of spending 10, 12 grand right now for a lower rate.
Yeah,
and it's coming to fruition. That'll happen again.
Yeah, we call it legacy costs. Like, if we're looking at really an ROI on something, I'm going to have a hard time looking you in the eye saying, you just spent on a $600,000 loan, $6,000 to get, 0.25% lower, and the market just naturally comes down over the next year, and we're already there. Now, hey, I want to refinance. Well, I just took $6,000 of your money and just threw it out the window. Maybe we take a little bit higher rate and just naturally we're a little more fluid when the next opportunity comes up, to your point.
Yeah, like, the things that you guys are saying are areas where I think that loan officers sometimes don't get enough credit. And I shouldn't say all loan officers, good loan officers don't get enough credit, is that we're technically selling the same product, but there's a lot of ways to structure the same product. So you could go to loan officer A and their opinion could cost you thousands of dollars, and you could go to loan officer B and they could go, hey, I have a different strategy, here's why. And you could be way ahead financially, even though loan officer A could have done the exact same thing as loan officer B. And what Rob was saying kind of with this collective group is that we check each other and we push each other a lot on why we think the way we think, and what the mindset is going into helping and serving our clients.
Yeah, it's a huge deal.
Eric, we got how much time?
We just crossed the 40-minute mark.
Is your Zoom about to go out?
The Zoom just turns off.
Turns off.
Do you guys want to touch on the realtor NAR thing at all? Or do you want to hit on it? Are we good?
Yeah.
I mean, we can talk about the RE source some more if you want. I mean,
these guys are like, I'm losing my job.
Yeah, no one wants to talk about the RE source, but we will.
Well, we sure will. Eric's making us. This is his burning it down on his way out.
Hey, you want to sit here and talk some shit too? Come on.
This is your time.
So before we shift gears and kind of talk about some of the big upcoming changes in real estate, especially with the realtors' commissions, one of the things I think trips me out, and I'm surprised that I didn't really understand this until a few years ago, is when they're talking about inflation. I think people are under the impression when they say inflation's is slowing down that they think it's going backwards, and they don't realize it's an accumulative. And so you guys, if you wanted to think about what inflation is, it's like saying that in 2019, I gained 10 pounds. And then in 2020, I gained 8 pounds. And then in 2021, I only gained 4 pounds. So things look fantastic. And you're like, no, dude, you're fat.
Yeah.
And that's what's happened with our money, was they were like, we're doing great. Inflation's coming down. And you're like, well, how come everything's still expensive?
Yeah.
It's because you haven't shaved any of the fat off.
It is the growth rate of inflation that's slowing. And so, things were 9% more expensive year over year, a year and a half ago.
Yeah.
And then they're now only 3% more expensive from the 9% though. It's still more expensive.
There was a comedian explaining that. It's like, okay, so you got this guy, and every month for last year, he gained 5 pounds, 5 pounds, 5 pounds, 5 pounds. Okay. And they're like, yeah. All right. So this year he's been gaining 3 pounds, 3 pounds, 3 pounds. It's like, oh, he's losing weight. No, he's a fat fuck. He's still a fat fuck. He's morbidly obese. This is horrible. Horrible. Inflation isn't coming down. It's just there's no more place to store the fucking fat.
God, so we've got fine art, we've got watches, we got fat shaming.
Yeah. But this all leads to the entire point is, if you think about money in the most fundamental way, all money is, and when I say money, I'm talking about every form of it. I'm not talking about just the pieces of paper. I'm talking about all forms of money. It's just storing your time, right? And that's really what you're doing. So if you got paid $20 an hour and you stored that, technically you should have saved yourself an hour of labor in the future.
Right.
But the issue that we have is, if you tried to store an hour of your labor 10 years ago, and then you're like, ooh, I'm going to borrow my hour of labor today, it doesn't work. But if you choose a different storage of your money, you can actually grow your time.
Right.
And that's what we're advocating here for today, is if you're thinking it's a great idea to take all the pieces of paper and store it that way, a harsh reality is going to happen, which is you're not going to have your time later. But if you store it in things like real estate or stocks or anything that you feel is a scarce, desirable asset, that's the only mechanism to have your time later. It's the only way to do it.
There's a roadmap to be wealthy in this nation, and it is to have assets. You see the CEOs of large companies have small salaries and large stock options because it gets taxed differently, and it's an asset that grows over time as opposed to just the cash. People who get into real estate and grow that wealth over time, it exponentially increases their net worth, and they didn't do anything extra for it. That exact point that you made, the money is going to be worth less, the things are going to be worth more. So while you can, get into things.
Yeah, that's an easy
get into
way
things while
get
you can.
into things.
Yes.
Yeah.
Message.
Yeah. So, Rob, you want to shift gears here? And
Yeah. I'm just gonna drink because you guys make me thirsty.
Slower.
I know, I'm looking at you while I'm drinking. All right. So yeah, Miguel, you brought up the kind of the big shift in the real estate market, and a lot of our friends and business partners that we work with, do life with and business with, there's some changes happening right now. And in my opinion, I think there's some good changes, not because of what's going away, but just what the opportunity is. I think when anything moves or adjusts, there's going to be opportunity for someone to take advantage of that opportunity and make it,
the best rise to the top when there's times of uncertainty and adversity.
So
and that's what they have right now.
Thinking through that, I had a 2-hour conversation with a friend of mine that I've been doing business with for almost 2 decades now, and he's one of the most calm, collected guys, and he was kind of all over the place yesterday, and he was just venting. I was letting him vent, and then we kind of walked through that, what that's going to look like, and like there's kind of a plan of attack on how we're going to approach his business together, and we're excited. It's like another boost of energy. Like it's an opportunity where if you feel like something's taken away, it's like that, one door closes, another one opens up. I think there's a huge opportunity for people that are, in the real estate community to take advantage of this. Just got to distill it down and get over the emotion side of it and the reaction side of it and figure out really what the essence is. And at the end of the day, you're still trying to get people into homes. It's just, the rules have changed a little bit. So
I look at it as realtors have always had to get hired to sell a house, to list a house. They've always had to go to an interview. They've always had to say what their services cost. They've always had to get an agreement for that for a certain amount of time. They're just doing that on the other side now. It's a job interview again, where you go and you put your best foot forward and you say, this is what my value is. This is what I bring to the table. This is why you're going to get more value than what it costs. And these are the opportunities that you're going to have when you work with me, for it to cost some money for you, or for not cost some money for you. It's just a job interview. And the best are going to go in there and they're going to nail it.
The transparency aspect is always good, in my opinion. Anytime something's more transparent, it's fantastic. And for the longest time, I think buyers didn't realize that you could have always negotiated how much you paid your agent. Now, I think that most buyers who had a pleasant experience go, my agent's worth their weight in gold, because I, at least from my experiences, I can say any of the agents that I work with, I definitely think that they provide a lot of value. I could see people who had bad experiences maybe go, hey, that was pretty expensive to not get the help that was needed. But in this whole circumstance of things, meeting up front, setting those expectation levels, signing your buyer's agreement, these are all things that I think just make business more clear, and business should always be clear.
In Washington, we've been doing it for 18 months.
Yeah.
The MLS in Washington, the Northwest MLS, published what the buyer's agent would be making from the seller, and some had zero. And I remember asking, this first came out, I asked a buddy of mine, what are you going to do if a client sees a home on Redfin or Zillow that pays 0% buyer agent commission, and they really want to see it and they want to buy it? And he's like, if somebody wants me to work for free, they're just not my client. And it was the most matter of fact, like, okay, fine. He's like, I go to listing agreements and they want a very reduced rate for the services I provide. I give them referrals to reduced rate agents who will do the listing for $500 or, for 1% or whatever the fee is. It's like, if the transparency part is good and it cuts both ways. If somebody expects more from me for less, like, I've got a family to feed and I've got expenses to pay, and I'm going to do a job that has value. And because that job has value, that job it's how we work in a capitalist society. Everybody that provides value should get compensated.
Yeah. Like, imagine that in other aspects. You're just like, this guy's going to do the tile for free for some reason.
Yeah.
And you're just like, what? Like, I just showed you 15 houses. And now if you buy this house versus those other houses, I'm not going to pay you. Right. That's bizarre. I don't think anyone thinks that's fair or that makes any sense.
Yeah. I was at a meeting earlier this week, and they were, the emotion, I think, was starting to come out in this group, as far as like, well, I can't work for free. But like, take a step back and understand that at the end of the day, when you're submitting an offer, you're negotiating already.
Right away.
It's negotiations. It's just one extra piece of the negotiation. And if you look at it holistically, like, let's all agree that most agents are going to, like, that's not okay. I need to get compensated somehow.
Yeah.
Most offers are probably going to come across the board, unless the buyer's going directly to the listing agent. Then you're just going to not probably get that deal. Negotiate it.
Yeah.
And if I always tell brokers, realtors, like, on the lending side, if we had like a buyer's agreement, like, our job would be amazing, because I don't know how many times I've spent months credit repair, and then it's like
all of it.
jankybank.com's got $4 less a month, because it's like, I'm going over there after you literally call the listing agent and get the deal for them, and then they leave you. I'm like, if I had commitment, that'd be amazing.
Yeah, we definitely have a contract, an unspoken contract, that we work very hard for people, and we hope that the service that we provide makes up for the things that we can't control. Because today my rate is a little bit higher than ABC Bank, and tomorrow my rate will be a little bit lower, because we just don't like the mechanics that go into producing an interest rate. We've gone over just a little bit of it. There's going to be that variance, but we don't have that. And speaking about compensation to somebody, I think agents have a whole lot of fear about this right now, but the market is going to work itself out. Nobody's working for free. People are saying the buyer's agents are going to go away and it's only going to be listing. That's not going to happen. Listing agents and sellers that list their house without paying any buyer's brokers are just going to show that the market is not going to have as many people go through your house, and you're not going to get the highest price.
If I was selling my house and you go, hey, list some of the value propositions of having a buyer's agent. So not my agent, the agent that's representing the buyer. To me, the most common sense thing is, if I cut the buyer's agent out and the buyer purchases this without representation, there's a decent chance I got to deal with a lawsuit later.
Yep.
Because when you have two professionals involved, that's easy. You're like, dude, you had your person. They told you everything they were supposed to tell you. I didn't hide anything. But when you cut that professional out, and someone's in your house now and they go, oh, the septic backed up. I'm like, dude, I pumped the septic, and now you're in a lawsuit because you don't have a professional. That value proposition alone, if I'm a listing agent, I'm always articulating that to the seller and going, we want the buyer's agent because we want to make sure that you're not in hot water later.
Right. And we've been in this business, all of us, for decades each.
Yeah, each.
And bought plenty of houses personally. And I tell the people that I work with all the time, like, I would not buy or sell a house without a real estate agent.
No, and we know what we're doing.
We know, and we've done it.
I've never in every transaction, I bought a house from a friend, and I still had a realtor help me.
Yeah. We do that. We deal with the paperwork all day. We deal with title companies and escrow companies, and we know what's required for a loan. Like, our level of knowledge, even still, I would not go in on a.
Well, it has to do with the emotion of buying a home. It's
That's
hundreds
huge.
of thousands of dollars. Like, if I'm looking at trying to refinance my own house or whatever, like, I can't make a decision. I like, hey, how would you do this? Like, I'm not thinking
You're thinking emotion, not
yours.
rational.
Yeah,
Yeah.
it's different when it's yours.
And we talk about the emotion of it. Like let's look at the business side of it when someone's getting pre-approved. What are you comfortable with? Like budget, everything else. Because as soon as you walk in that front door and you're in the foyer and it's hard not to envision your family there. And it's an emotional thing. It's competitive, all these other things. You might overlook something. You need someone that's professional. It's the same thing like Tom Brady, best ever. I mean, if you agree or not, whatever, based on, success, he still had a quarterback coach. He still had someone that was looking at him like, hey, watch out for this, right? There's use that as an analogy, but I think
Michael Jordan had a coach.
Exactly.
Griffey had a coach. Barry Bonds,
I know we're not,
We're just going to talk about old sports guys now because let's do this.
Yeah.
Did you just compare yourself to those guys?
Yeah.
Not myself, himself.
Yeah.
He's comparing himself.
Good kids. We're talking about great
Tom
kids.
Brady was like, even Rob Blair of Mortgages and Puyallup has a business coach, so I'm having a quarterback coach.
In fact, he was inspired by Rob Blair to get his coach.
All right. Well, I didn't want to say anything, but
but he did make sure we said it.
This whole change is really the smallest of nuance, and it's exploding people's heads. Because when I think about this, I'm like, in almost every circumstance, the buyer could have already done whatever you're nervous about. So if the buyer wanted to cut you out and go directly to the listing agent, they could have cut you out.
They could, and they had.
And if you wanted to sue them for commission, like play it out, you're going to be the agent that's known for suing a buyer to get paid. You're not going to do it. That'd be a career suicide.
Right.
So in most of the circumstances, all the things that the realtors are really worried about, they could have already happened. It's just now they're telling you that it can happen.
and these people that are coming in to buy houses, it's their first time, or maybe their second, third, maybe their fourth. Not a lot of people buy more homes than that. Having the rules that are changing for these buyers, they don't really even know it. It's just the way it's done now, the same way that it was the way it was done when they were introduced to the realtor either the last time they bought a house or had never been. Like, okay, well now I'm going to be contracting your services. Here's our agreement with each other.
I was at a meeting, and this is like when this first came out, and again they were kind of freaking out, change and all like. I'm like, this is really good. I mean, let's look at the good things versus the negative things, and that might not feel good or that might suck or whatever, but that's what it is. So okay, feel that for a little bit, but you gotta get past this because your competition is. But why don't you call your lender friend and your financial advisor friend that literally their entire compensation plan and got gutted. I mean, after 2008, Dodd-Frank,
worked out great though.
Exactly.
Really
did. Talk to me
really
about
did.
it. Like it sucked when it was happening, but now it's like, that's actually the best thing that ever happened, honestly, because it just leveled a lot of things out.
People were quitting off of the announcement without knowing what happened. I remember being in the business and people were just like, oh, we're done. Throw the paper and quit. And then a year goes by and you're like, oh, this is kind of nice. I don't have to sit here and think about what I'm going to charge somebody. They took that piece away from me.
It makes you
and
feel
now I just provide value. And if I provide value, people use me.
And the consumer then knows that like this person gets paid the same whatever my rate is.
Yeah.
This person gets paid the same whatever my loan. Like they just get paid the same as opposed to before where you're thinking, is this really the best rate? Or are they making money off? And we knew people that did that and it was disgusting.
Oh, everybody's seen The Big Short.
Yeah.
Dude just hitting the home runs off of, and I tell people. That's kind of part of the thing I tell customers. Like if my mom walks in the same day as my worst enemy and they have the same credit score, same down payment, same everything, I have to legally give them the same terms, even though it's my mom.
Can we stop? Do you have a nemesis? Do you have a worst enemy? I mean, we know you, so probably a lot.
There's so many people that hate me.
You're a lot of people's worst enemies. They're not yours.
Yeah, I love everybody, but there's people who don't like me.
That's much the other way.
Yeah. I feel like I'm your best friend, but you're not my best friend. I feel like I'm your worst enemy. You're not my worst enemy.
It's not equal. It's not fair.
Well, do you guys want to kind of end with something here? Just some basic advice that you would give for your customers today? Like what's the one thing that you would leave someone who's entering the market?
The best hedge against inflation is a 30-year fixed mortgage. It just is.
I'll probably leave you guys with ignore all the noise. Don't try to time the market. If you're in a position to buy and you have the desire to buy, just go do it.
I got nothing.
All right.
Love it. Good work, guys.
I appreciate you guys. No,
Yeah.
Again, back to the reason why we wanted you on here is exactly what we talked about today. So a lot of value here, a lot of education, a lot of knowledge, but going back to being hyper local, working with a professional, this is what we do for a living. It's a mastermind. It's a hive type mentality where we're not just shooting from the hip. It's like, so it's you get a collaborative effort behind it.
Yeah, we all do better when we all do better.
Absolutely.
Yep, definitely.
Absolutely. So I appreciate you both. Consider your friends, and blessed to be working with you guys. So thank you.
Thank you.
All right.
Good work, guys.
All right, let's turn these cameras on and do it for real.
Yeah.
Oh, they didn't record on purpose.
Oh boy.